Hey everyone, and welcome to this explainer. Have you ever jumped into a trade that looked absolutely perfect, only to watch it instantly reverse and smash right through your stop loss? Yeah, we've all been there, and it's incredibly frustrating. Well, today we're digging into some really fascinating source material on smart money concepts, or SMC, to uncover the institutional playbook for defining value. We're going to find out exactly why those nasty reversals happen, and more importantly, how the pros actually manage to avoid them. It's the million-dollar question, right? Why on earth do retail traders end up buying exactly when the smart money is selling? We've all felt that relatable pain of buying into a massive, exciting breakout, feeling like we're finally catching the trend, only for the price to immediately crash. Well, according to the playbook, this happens because retail traders frequently trade on emotion. They chase the excitement of a fast-moving price. Institutions, on the other hand, they literally do not feel FOMO. They trade on cold, hard math and structure. They know exactly where a market is expensive and exactly where it is cheap. Okay, let's dive right into this. Here's our roadmap for today. 1. The retail breakout trap. 2. Mapping the dealing range. 3. Equilibrium as our value filter. 4. Premium and discount zones. And 5. Executing smart money concepts. So, starting off with Section 1, the retail breakout trap. To really wrap our heads around smart money concepts, the sources suggest we first have to understand the behavior of the average retail trader. We really need to contrast the emotional trader who's constantly chasing price against the patient calculating algorithms that institutions use to execute their massive orders. Think about it like this. Buying a breakout after the price has already surged is kind of like walking into an electronics store and offering to pay way above the retail price for a new TV. You would never do that in real life, right? But traders do it on the charts every single day. When a market looks the most bullish, the most unstoppable, it's often heavily overvalued. That's exactly when retail buys, and that is exactly where institutions, the smart money, are looking to take profit and distribute their positions. They are more than happy to sell you that overpriced asset. Moving right along to Section 2, mapping the dealing range. So, how do we actually stop paying those retail prices and start buying wholesale? Well, to navigate price delivery safely, you can't just stare at a blank chart. You need a map and you need a compass. Without defining the specific territory you're trading in, you have zero context for whether a price is currently cheap or expensive. Our map in this methodology is called the dealing range. The definition is simple, but it's incredibly powerful. It's just the price movement between a clearly defined significant swing high and a significant swing low. Finding this range, the most recent major move on your chart, is step 1 in the institutional playbook. If you can't identify an obvious high and low, you don't have a stable sandbox to operate in. You've got to anchor your analysis to these 2 points.
That brings us to Section 3, equilibrium, the value filter.
Okay, once we have our map, we need to draw a line right across the middle of it. If our dealing range is the map, think of equilibrium as the equator. This single line is going to divide our dealing range map into 2 entirely different hemispheres, and they have completely different rules of engagement. Equilibrium is defined mathematically as the exact 50% midpoint of your validated dealing range. You just calculate it by adding the high and low prices of your range and dividing by 2. Easy enough? In algorithmic execution, this 50% level represents the fair market value of the asset relative to its recent structural cycle. It is a perfect state of balance. So, the absolutely crucial point here is that this 50% mark is an objective filter for your market bias. It is not an entry trigger itself. Seriously, entering a trade right on the 50% equilibrium line is a terrible idea because you are trading fair value, meaning you have absolutely zero statistical edge. Instead, we use this 50% line strictly as a boundary that dictates our directional bias. It tells us exactly what we should not be doing. And this brilliantly illustrates a massive point of confusion I see out there. Traders constantly confuse equilibrium, or EQ, with equal highs and equal lows. Guys, they are completely different. Equilibrium is a mathematical valuation metric. It's your directional filter. Equal highs and equal lows, those are liquidity pools. They're basically double tops or bottoms where retail stop losses cluster together. The market algorithm treats equilibrium as a state of balance, but it treats equal highs and lows as magnetic targets to be swept in a stop hunt. Never confuse a value level with a liquidity target.
All right, let's get into Section 4, premium and discount zones.
Now that we've established our 50% boundary line, let's explore the 2 hemispheres it creates. The equilibrium line imposes some really strict rules of engagement for each half of your dealing range. If you actually follow these rules, you automatically eliminate a massive chunk of the bad trades that trap retail traders. So everything above the 50% equilibrium line is the premium zone. In this upper half of your dealing range, the asset is mathematically considered expensive or overvalued relative to recent price action. This zone is strictly for institutional selling, distribution, and taking profits. If you are looking to short the market, this is the only zone you should be looking in.
Conversely, everything below that 50% equilibrium line is the discount zone. Down in this lower half, the asset is considered cheap or undervalued. This is your wholesale area. This is where smart money patiently waits to accumulate long positions. If the overarching trend is bullish, institutional traders are definitely looking to buy the dips, but they will only buy those dips if the price actually drops down into this discount zone.
Now, what's really interesting here is the stark contrast in the operational rules. Premium is greater than 50%. It's overvalued, so you only look for sell or short setups. Discount is less than 50%. It's undervalued, so you only look for buy or long setups. Think about it. If you're buying up in the premium zone, you are literally providing the exit liquidity for the institutions who bought down in the discount zone. Don't be that trader. Let's bring it all together in Section 5, Executing Smart Money Concepts. So how do we actually trade this? Knowing the zones is step one, but now we need to blend this framework with real execution models. In the ICT, or Inner Circle Trader methodology, this is where we bring in the premium and discount arrays. To make sure you completely avoid that retail breakout trap, you have got to memorize these golden rules. Never, ever buy in premium. Never sell in discount. Always treat equilibrium as a filter to tell you if you're in the cheap or expensive half, but never use it as your entry trigger. Instead, you wait for smart money tools, like fair value gaps or FVGs and order blocks, to appear inside the correct zone. Seriously, a bullish order block only matters if it forms down in the discount zone. The sources highlight something incredibly specific right here. Within these zones, institutional traders look for highly targeted entry points. They often refer to the optimal trade entry, or OTE, which is a band between the 62% and 79% retracement of your range. But the absolute sweet spot, nestled deeply within the discount or premium zones, is the 70.5% level. If you spot a bullish fair value gap sitting exactly at the 70.5% discount level, you have found a high probability institutional setup. It's honestly fascinating to see how mathematically precise these concepts can be. Let's move on and see how this builds into your daily routine. Whenever you open a chart, the sources suggest following these 3 actionable mechanical steps. Step 1, zoom out and find the latest major swing high and swing low to define your dealing range. Step 2, mark that 50% equilibrium line right across the range. And step 3, practice extreme patience. You just wait for the price to enter discount if you want to buy, or wait for it to enter premium if you want to sell. And hey, if you doubt the power of this simple 50% rule, just consider how automated algorithmic trading works. This quote from Nikolai Tvarnitsky, a trading expert at 3 Commas, is incredibly revealing. He notes that equilibrium is just a common sense filter for algorithmic trading bots. When the market ranges, grit bots are literally programmed to ping-pong safely back and forth across this exact equilibrium line. And when trending, DCA bots are programmed to only execute buy orders when the asset drops into a discount zone. Even the machines refuse to pay premium prices. All right, that brings us to the end of our explainer. But before we go, I want to leave you with one provocative question. I want you to ask yourself this every single time you look at a chart, right before you click buy or sell. Are you paying a premium, or are you buying at a discount? Are you trading with retail emotion, just chasing that shiny breakout? Or are you trading with institutional discipline, waiting patiently for wholesale prices? Apply this premium, discount, and equilibrium framework to your own charts and just watch how it transforms your perspective. Keep learning, stay focused, and I will see you in the next explainer.